Good afternoon and welcome to this session. Today I will talk about quantitative investing, which is our primary focus here at Alpha Growth Capital. And my name is Vittorio Manente and I'm the founder and managing director of the company. And before we deep dive into the presentation, I would like you to read this disclaimer. And with this done, let me start by giving you an introduction of the company. The company started in 2017 and it started out of a personal need. And the need at that time was to break the risk and reward of the financial products available for retail investors. We are currently based in Switzerland and we are a quant firm. And we're using a statistical approach to take decisions when it comes to investing in the financial market. By background, we are engineers and we're using a scientific method to solve all the challenges that are associated when it comes to investing and developing investment decisions. Our flagship strategy was incepted in November 2017 and it's called Next Alpha. And we provide access to Next Alpha to both retail and professional clients, mostly through separately managed accounts. At Alpha Growth Capital, we believe that there is always a mechanism that is driving the price action inside the financial market. We do not think that the price action in the market is as stochastic as it might look like in appearance. And what we are constantly doing is try to understand how this mechanism is working. And the reason why we want to do that is because once we better understand how the mechanism is functioning, then we can take better investment decisions. And let me give you an example of what we think it happens in the financial market with this tripod pendulum. So in this video you can see a tripod pendulum. There are some forces acting on it and the pendulum is swinging and it's generating this yellow line. This yellow line might look like random in appearance, but in the reality what we know is that we have a mechanism that is generating this line. And we think that is exactly the same that is happening inside the financial market. We have a mechanism, it's just not as clear as we might want it to be, and we're constantly trying to understand how this mechanism is functioning. Over the years, we have tried a number of ways to improve and take investment decisions. We started with a momentum-based approach, and we have then transitioned into machine learning. We have also investigated deep learning. But at the end, what we saw is that to take decisions based on statistics is the most robust and effective way. And we're using statistics to perform a variety of tasks. We use statistics to identify entry and exit price levels, and we use statistics to design our position size. And when we're dealing with statistics, parameters like the maximum drawdown, the volatility of the strategy, and our targeted return for a given risk that we're willing to take, they all become a design parameter of the strategy that we're building. And let me illustrate our approach through an example. And the example that we have over here is investing in the Nasdaq 100. So if we would like to invest in the Nasdaq 100, we simply buy and hold this asset. Then our return is mirroring this light blue line. And if we would like to improve our returns, then we can think about using deep learning. So our return would be mirroring this orange line. We get results that are somewhat better than buying and holding, but not substantially better. And if we want to go one step ahead, we can think about using machine learning. And machine learning provides much higher returns, but as you can see over here, the volatility and the drawdown of the strategy is not exactly where we want it to be. And to close the loop, what we think is the best approach is to use statistics. And this is because statistics enable us to achieve similar returns as when we do with machine learning, but at much lower drawdown and much lower volatility. And when we're dealing with statistics, what is important is consistency, because the more we trade, the more the results are gonna get closer to the expected probability of returns. Moving on, let me talk about our flagship strategy, Next Alpha. Next Alpha has been incepted in November 2017, and since then we have been investing in US equities, US Treasury bonds, gold, and volatility products. And since then, we always use models to take investment decisions. We have never used subjective decisions. We use models to identify in which asset classes we would like to be invested in. We use models to determine position size and when to enter and exit a trade. And what I will show you now in this chart is the gross performances of Next Alpha and its benchmark index, which is the S&P 500. And what we are particularly proud of is the very low correlation of Next Alpha with the equity market. We are only 15% correlated with the market. The strategy has been evolving over time, and the reason why we did that is because we constantly strive to make it better. And when I say better, I mean better investment decisions. So since the beginning, we always been investing in uncorrelated asset classes, equities, bond, gold, and volatility products. But what has changed over time is the way we take decisions. When we started, we were using a momentum-based approach, and we have then complemented this approach with some kind of smart exit signals. And with these, we were going cash when the price action was moving against our position. We have then transitioned into machine learning because, as you have seen in the previous slide, machine learning enables us to increase the return with similar drawdown and volatility as we were getting when we were using a momentum-based approach. And since October 2020, we have transitioned from machine learning into statistics, and this is because statistics allows us to have similar returns as machine learning, but at much lower drawdown and much lower volatility. When it comes to risk management, we are using diversification primarily as a tool to decrease the maximum drawdown and reduce the volatility of the strategy. We are using a modular approach. So when we find an investment methodology or a decision process that in our opinion is robust enough, we take this process and we apply to different asset classes. As a result, we are able to create a bucket of uncorrelated strategies that when put together, they have very low correlation with the equity market and low volatility. And let me illustrate this through an example. So let's say that we have three uncorrelated asset classes, equities, bonds, and gold, and we apply our statistical approach to these three asset classes. In some cases we can reduce the drawdown, in some other cases we're improving the annualized return, in some other cases we do both. We then merge these three sub-strategies together and we have our optimized time series, which as you can see has much lower drawdown. The consistency of the strategy is pretty high. We have a Sharpe ratio above 2 and the return of investment is quite decent. When it comes to take decisions based on subjectivity, we prefer stay away from this approach. And back in 2011, when I got into the financial market, at that time I was investing based on expectations on where the market might move in the future. And sometimes I was losing money for a couple of reasons. The first reason, because the decisions were wrong, and the second reason was because emotional biases were getting on the way. At Alpha Growth Capital, we have some models that are able to reproduce the trend of the equity market. And with this model, what we might think of is to take directional bets. So let's say that it's December 2019 and we want to decide whether or not to go long or short in 2020. So we perform a forecast. The forecast says that the market will go up. And based on this forecast, what we then do is to go long on the S&P 500. Then the COVID comes, it's March 2020, the market drops sharply low. In April and May, the Federal Reserve starts a very large fiscal stimulus, and as a result, the behavior of the market is quite erratic. And when we have such a complex situation to deal with, in the heat of the moment, we might really take the wrong decisions because we might not understand exactly what's going on. And for all these reasons, we prefer to use statistics rather than take directional bets. And when it's about developing a strategy or developing a new way to take decisions, we are leaving nothing to chance. We start with an idea, and we are then building very complex computer models which allow us to analyze very large data sets quite quickly. We then perform a parametric optimization of this idea, and once we have done that, we create an optimized time series. Once this has been done, we are comparing our optimized time series with the bucket of sub-strategies that we are currently implementing next alpha. And if we see that there is a fit, we perform a front test on a real account. And the reason why we do a front test on a real account, it's because we want to verify that we haven't done any mistake with our model, and we also would like to verify the strategy can be implemented in real life. And if everything goes okay, then we take this new strategy or way to take investment decisions and we implement it into next alpha. And let me give you an example of our approach through a case study. And the case study is investing in volatility. So let's say that we want to profit from the natural decay of long volatility products. And one of the easiest things that we can think of is to short this type of products and then rebalance the number of shares at the end of each day. And if we do that, we get a time series, we get a return on investment that is quite volatile and it has a lot of drawdown. So it's not as easy as it might look like in appearance. So at this point, we start with some research questions. And after having identified all these research questions, we build computer models to provide us with an answer to all these questions, and based on the optimal answer, to generate an optimized time series. And if we go back to the previous example, this is the case of this light blue line, which performs much better than simply shorting the VXX and rebalancing the number of shares. And again, this is for illustration only, because if for instance we would like to invest in volatility, developing a new strategy or developing a new way to take decisions, there is much more that has to be done. And this is concluding my presentation. And in conclusion, at Alpha Growth Capital, we believe that the price action is not as random as it might look like, and there is always a mechanism that is driving this price action. We are constantly trying to understand and model this mechanism, because by doing so, we can define the risks, improve the consistency of our returns, tailor the expected return for the given risk that we are willing to take, and create an overall strategy that is loosely correlated with the equity market. And when we come to developing a new strategy or a new decision-based approach, we are leaving nothing to chance. Over time, we have proved that, at least for us, statistics is the best way to take investment decisions, much better than machine learning, much better than deep learning. And with this, I would like to thank all of you for the attention, and I will take any questions. Thank you.